For a first-hand look at the economic view from the corner office, we turn to the president and CEO of Empire Industries. Guy Nelson's in studio. Good to see you again.
Good to see you.
A big manufacturing type organization, I'm sure, benefits when the Canadian dollar is where it is. But having said that, let's start right at the top. Are you in the camp that we are, in fact, in recession?
I'm not in that camp. I'm in the camp that says that Canada, it depends where you are in Canada. If you're in the energy sector, then you clearly are in a recession. Mm-hmm. If you're in the consumer part of our economy, then you're not in a recession. Interest rates, oil prices all benefit the consumer, and the consumer represents almost 2/3 of our economy. So in that sense, I can see a lot of CEOs are primarily focused on the non-consumer part of with their businesses, might not see it the way I see it.
Because of your exports nature, has the Canadian dollar helped you at this point, or are you yet to feel it?
No, we feel it immediately. We sell our product in U.S. dollars, and that doesn't change, right? Because it's a global commodity, it's a global product we sell. And so any drop in the Canadian dollar is just goes to our bottom line, and so it's very beneficial.
So if the discount of the Canadian dollar against the greenback goes directly to your bottom line, does it at some point trickle down into the workforce? Does it lead you, the Looney itself, does it lead you to say, okay, I'm going to hire more people?
Of course, yeah. In our case, that's exactly the case. It's not just the price, not just the margin, but it's also the volume. So we're selling more of our product internationally, and so the combination of the strengthening margins and increased volumes do have us hiring. Our workforce is we're a bit of a unique case in some senses, but we have tripled in size, and we continue and will continue to grow.
And 2 out of 3 revenue dollars, I think, comes from the United States right now?
It's actually a little more than that, because that other third is franc, unfortunately, the part that's dependent on the Canadian dollar and selling it within Canada.
When we asked the corner office about taking eggs out of the American basket, where ought those eggs go? The respondents for Asia were a fraction of what they were this time last year, and the European Union actually leapfrogged Asia as the place to be right now. Are you in Asia?
We're in Asia in a big way. Again, in the consumer side of their economy. Their consumer represents approximately 30% of their economy, and growing. The part that you hear about in China that's not growing is, of course, the demand for our minerals, our resources, our oil, and our gas. Right. That growth has come out of their economy, and that's impacting companies in China that are dependent on export growth, and it's also impacting Canadians that are exporting into that market.
Does Europe appeal to you?
Europe does, but it's again in the mature side of the entertainment business. It's been there a long time, but all people in the entertainment business are spending quite heavily. The Disneys, Universals of the world, and then all of the others that are emerging to provide entertainment for the growing middle class. That part of the economy is growing most quickly in Asia, as well as in the Middle East. Oddly enough, in the parts of the Middle East, I'd say I don't think you necessarily want to be doing everything we do throughout the Middle East, but in UAE particularly and Qatar are spending heavily.
Well, let's step back then and talk about your product itself, what it is you make and for whom it's appropriate.
Okay, so the product we make is entertainment product like amusement rides, theater products, roller coasters that are indoor that use media. All of our products are iconic attractions like that draw people to amusement parks, and so that is in big demand.
In particularly where you've got that greater disposable income.
That's right.
Wage growth has been a big issue in the United States. It's starting to gain some traction. Are you seeing evidence of that?
Yes. Again, the Disneys, Universals, Cedar Fairs, the park operators, Six Flags, are in a growth phase of their capital spending. It's a cycle, and they're spending money on upgrades.
So then what's the lag time between when we get an indication that, yes, an economy is doing well, such as the United States, and the point at which Disney picks up the phone and calls you because they need a new amusement ride?
I would say those decisions, these are big decisions for even those companies, which are big. They're long-term decisions that don't turn on a dime. So in the case of Disney, I'll use them as an example, I know them quite well. They're building a park in Shanghai. That's a $5.5 billion undertaking, probably took 10 years to negotiate, 5 years to build. And so that's a long-term cycle. And they're coming towards the end of that, and the park will be opened, and they were already planning phases of growth beyond that. So it doesn't turn on a dime. It's a long cell cycle. People make bets on the growth of the middle class. Where is it going to be? Where's the disposable income going to be? And they make their plans accordingly. So they do pick up the phone fairly quickly, and they're picking up the phone now.
Before we let you go, half of the respondents said that a balanced budget in this country is important, but only 11% said a balanced budget in this country is important to them. Is it important to you?
I'd say Canada has, it's in a difficult position right now because we have an economy that has been somewhat dependent on oil and gas and minerals and resources, and we need to shake that down a little bit. So I think that in this case, I think we have to invest a little bit more and not be hung up on deficits at this moment, because I think we have to invest in the economy to make the structural adjustments to be more competitive going forward.
Thank you so much for your time.
You're welcome.
Guy Nelson, President and CEO of Empire Industries. We're back after this short break.